Thank you. Thank you very much for the kind introduction. Unfortunately, I'm not president of corporate and chip finance. I'm a small professor. So I'm one of the academics that Basil said will also participate. So when Basil asked me to come here to wonderful Athens, he said I should talk a little bit about risk in shipping, what that means from the perspective of capital markets, what that means to cost of capital for shipping, and what that means to risk management. So I put my little presentation under the title Corporate Risk Management in the Shipping Industry, and I understood my task as giving you a little mini lecture, but hopefully not too boring, but a little bit entertaining, about what academics have to say about risk and risk management and capital markets in shipping. So when you think about shipping, of course, the first thing you think of is what are the risks in shipping? And I think there are, if you classify these risks, there are two major risks that the ship owner has to consider. The first is obvious. I call it operating exposure. This is, of course, everything that affects your cash flows, that affects the variability, the volatility, as we say, of your cash flows. And obviously, that's freight rate volatility that ultimately translates into your volatility and operating and voyage costs. And then you have some other special things like interest rate risk, currency risk, counterparty risk, and so on. And the second one is a little bit less obvious. That's a risk that has only become visible recently with the emergence of all these international accounting rules, which is the vessel price risk, which obviously affects your balance sheet, because under fair value accounting, if you have a permanent devaluation of the asset, that ultimately triggers down to your equity capital in the company. And it also triggers down to the bank's equity capital, because if the collateral value goes down in value, the bank also has a problem. So these volatility in the value of the asset has become an issue, and all these rules in international accounting standards are pretty complicated, so I just want to leave it as it is. So having said there are many risks, these two types of risks, what does that mean? How can you quantify that? And Basil already mentioned these. Many of them were Greek ship owners that went to the stock exchange. I mean, when we as academics do some empirical research, we need data. And unfortunately, we only have access to this public data. If you give me private data, fine, I do it. But so we rely very much on these listed shipping companies around the world, and we put a lot of effort in that, and we collected like 150 listed shipping companies. We think that's a pretty comprehensive sample. And you look at the returns over a very long period of time. That's 1973 up to 2014. That's when the paper was published. So just look at the very simple characteristics of the return distribution. You will find that the average monthly return is, whatever the number is, there is a negative sign on that. The average return was negative. That doesn't necessarily mean that every investor lost money, but just the mean of the monthly return of these companies was negative. So by all means, that does not look very attractive for portfolio diversification from an investor's point of view. Not talking about correlations and all these statistical concepts we have. A mean return doesn't sound very attractive, and you have a very high volatility. So the deviation to the left and to the right from that mean is pretty big. I mean, in our sample, we get a volatility of more than 50% per year for a single stock. Now, to compare that with an index is a little bit unfair, because the index is perfectly diversified. All the risks that you can are already got out. So let's say these single shipping stocks have an average correlation of 0.4, and then you can show that an equally weighted portfolio converges to 32% per year, but still if you compare that to the MSCI World, so our broadest stock market index that we have, the MSCI World has a volatility of roughly 15% per year. That's a rule of thumb for most of the worldwide stock indices we have. So the shipping stocks are double in risk. So by all means, shipping is risky. So these risks do translate into higher volatility. That's the basic message, I think. Now, what can you do with these risks? And the literature suggests three things you can do. Either you're really strong, you can retain the risks. And ultimately, you have to have sufficient equity. If you have sufficient equity and you can bear the risks, you can finance the risks, fine, you're set. Okay, you don't have a problem. Most or some of them might not be able to finance all these risks, so you might try to neutralize these risks by changing your operations. To some extent that might work, by diversifying your fleet, which reduces volatility, but these possibilities are limited. So a lot has to do with transferring risk to somebody else in the market. So giving the risk out from your own balance sheet to somebody else. We call it risk transfer. And we have the chairman of the Baltic here, so they have these instruments. They are there. We have these freight rate derivatives. So from my perspective and from the literature perspective, if we talk about risk management, there are three things that are all happening simultaneously. It's not so easy to isolate them. Adjusting your operations works to some extent. Employing these novel risk transfer product and adjusting capital structure. Because ultimately your equity is the final risk-bearing instrument. Now, in the end, I will conclude that maybe it's not a good idea to don't do anything of these three things. At least you should do something of these three choices. But look at another paper we did. We looked at, if I talk about capital structure, look at leverage. So this is the pretty much same sample of these globally listed shipping companies, and we look at leverage. And the result is what you might have guessed and what you know already. The dark lines here are the leverage ratios of these listed shipping companies. Leverage, defined as interest-bearing debt over total assets, so short-term debt plus long-term debt over total assets, both in market terms and in book terms. Without going into details of the numbers, what you see is that compared to all other industrial companies that we have, these are thousands of companies, the thin lines. There are thousands of companies, all our big databases. But the snapshot, the bottom line is that the shipping industry is highly leveraged. So given that you have this cyclical risk, this operating risk, and you have a lot of financial leverage, a lot of financial risk for the shareholders, for the owners ultimately, for the equity holders, probably shipping companies are good candidates to engage in some risk management activities. Because having both the operating risk and the financial risk is probably not very attractive for your investors. The question, of course, now is what is the optimal aggregate risk profile? What type of risk do you retain and what do you transfer? So that's a top management task to define what is this optimal risk to transfer. Now, one party to transfer the risk is the banking industry, as Basil already mentioned. And the banking industry is undergoing big changes, and it's more and more difficult. Without going into all the details, I think we have a talk afterwards, after me, also from Hamburg. They're going to talk about what's happening in the shipping, in the banking industry. But I think what ship owners have to understand that shipping firms compete with other industries for the most important source of a bank, which is the equity capital of a bank. Because the bank has to, for every euro loan that the bank gives out on its asset side, it has to maintain some equity on the passive side. And given the risk of shipping, the amount you have to maintain as equity is very high. So shipping has a tough fight against all the other opportunities the bank has. So my prediction is, and I think there are many out there that think the same way, that many shipping banks change the roles from being a house bank, which they still will be for some of the good addresses, to more of an arranger of financial solutions. Let's sloppily call it investment bank. Now, if the banks don't do it, and this is the only two formulas I have, and I don't go into details, but being a professor, I have to have two formulas. You have to allow me that. The question is, of course, now, if the banks don't do it to the same extent they have done it in the past, who's going to take the risk? And textbook finance says if indirect finance through bank intermediaries doesn't work, well, you go to direct finance through the capital markets. That's what Finance 101 tells us. But then, of course, the question is, what is the price that investors demand? What is the expected rate of return? And that's the cost of capital for you as a ship owner, because you should only put money into projects that earn at least the cost of capital for these equity investors. And we have a model for that. The model has a lot of problems, but this is the model. The model says, well, the expected return that the ship owner, that an investor would demand, be it bond or equity, so both debt and equity, is at least you want some risk-free rate, obviously, whatever is risk-free in today's world. That's not so clear what that is today. And you want some premium for risk. You want to be compensating for taking over risk. And it turns out that this risk is a function of the famous beta, and I don't go into detail, there are databases for that, the beta, times what we call the equity risk premium, which is the average expected return on the stock market minus the risk-free rate. Now, it's a little bit more complicated because the company consists of both debt and equity on the passive side. So we have to compute a beta that's both for debt and for equity and weighs the two things. So we have a debt beta and we have an equity beta. We weigh that with the weights in the balance sheet of debt and equity and come to asset beta, the total company beta. And we just use that company beta in the last formula I have, in our little nitty capital asset pricing model formula. Now, the rule for value creation is every project that you implement should at least earn that cost of capital. That's the expected rate of return the investors have. The question is, how do you come up with a specific number? Unfortunately, that's not so easy. And everybody who tells you that he can pinpoint that number, don't believe it. It's pretty tricky to estimate that, to put a number here. And let's give it a try. For the risk-free rate, well, go to the database, take a 10-year US Treasury bond, standing at a yield of roughly 2.8% last week. Estimated beta, also okay, you can do that. Go to Yahoo Finance, key in ship, and you find all the listed shipping companies, and you can find betas. And it turns out that the betas of typical betas for shipping companies are between 1.5 and 3, so pretty high betas. They're relatively high compared to other companies, reflecting the risk. Now, what is the beta of debt? Well, you can also go to databases, and for what I do is I take, as Basil mentioned, most of the shipping bonds are non-investment grade bonds. BB rated bonds is the average I found in a couple of publications. And Moody's, for example, and S&P, they give you a debt beta of 0.2 for these type of quality of bonds. So assume, just make it very simple, 50% debt, 50% equity, weighing that gives an asset beta of 1.5. Toughest part, estimating the expected excess return on the stock market. And that's really tough because many people will give you very, very different answers. And to make it very short, I say, well, this is an expectation. I don't know what the expectation is. I cannot observe an expectation, but I go to my historical data and take an average. But taking averages is not so simple as you might think. Depends a lot on the time period, takes a lot on how you measure the average, in sense of you simply take the years, add them up, divide them by the number of years, or that doesn't really reflect your investment performance, in fact, without going into detail. So concluding that is, there is a huge range of risk premia that you can expect, that you can take. And in my simple example, you come up with cost of capital in the range between 6 and 15, 16%. That's unfortunate because it doesn't give you a good answer, of course. But that's as it is, unfortunately. Now, I have 2 more, and then I need 2 more minutes if I have the time.
You have 1 minute.
1 minute, okay. Now, fine.
You have a minute from me.
Okay. So now, what I want you to see is the question, of course, now is, knowing that this is the wide range of cost of capital that you face, with risk management activities, can you influence that cost of capital? Because, of course, you would have a low cost of capital, obviously. So can you implement risk management activities to reduce this cost of capital, this hurdle rate? And saying it bluntly, trading on the spot market and having 90% leverage probably doesn't do the job. That's not attractive from an investor point of view. The investor will require a very high cost of capital. So are there good theories that we have, and that's my last slide, are there good theories that tell you, well, there are certain measures that you can take in place to increase investor attractiveness and to reduce your cost of capital? Yes, there are. 2 examples: mitigate excessive risk. Mitigate deadly risk. Because, I mean, you can diversify as an investor. I can buy all these shipping stocks, tiny percentages of it, and diversify myself. That's fine. But if the company goes bankrupt, this imposes cost also on me. So if you tell me, well, I manage my deadly risks in order not to go bankrupt, for me that means I put a lower hurdle rate. That's one reason. That's one real cost that's imposed on me as a shareholder, as an equity provider. And the second one I think is important, speaking in front of shipping Greek owners, my last point, coordinating investment and financing policies. Going to the market is the most costly alternative. You go only to the market if you don't have internal money. Internal funds is the cheapest, obviously. And if you can provide foregoing investments because you don't want to go to the market because it's excessive, the cost of capital that the market charges you, but nevertheless, having your risk management activities such that you make sure to have money every time you need it rather than going to the market. For example, enabling asset players to buy at fire sales at this point in time. If you go to Hamburg, you probably know you can buy many ships at fire sales. If you have cash now, cash is king now. So if you have a risk management policy in place that allows you to have the money when you really need it the most, that's valuable for investors. And final thing, just 10 seconds, you would of course say, well, these are all theories, and can you prove that? Unfortunately, I cannot for the shipping industry. We tried to do that actually together with the Baltic Exchange. We sent out many surveys and questionnaires to ask ship owners and tell us a little bit about what they're doing in risk management, but the response was not very high. But there is a similar industry, the airline industry. And there is lots of publications on airline industries that shows that corporate risk management can increase firm value by reducing your cost of capital. And I would think that given the similarities between, at least to some extent, between the 2 industries, that might also work for shipping. And with that I conclude. Thank you very much, and I hope it was a little bit interesting and entertaining. Thank you.